Are you still confused about where your money should actually go in 2025? Because if you're like most people, you're either overwhelmed by too many options or you're just letting cash sit in a savings account doing nothing. I get it. I was in that same spot years ago, making mistakes that cost me valuable time and growth. That's why in this video, I'm breaking down exactly where to put your money this year, from beginner-friendly strategies to pro-level moves. So by the end, you'll know how to grow, protect, and maximize your money in 2025. Most people don't realize that one of the biggest financial problems they face isn't overspending or even debt. It's the silent drag of letting their money sit idle in a low-interest savings account. The issue is simple. The world around us is changing quickly. Inflation is eating away at purchasing power, and banks are notorious for paying next to nothing on standard savings. So when you check your account and feel good about the balance sitting there, what you don't see is how much value that money is quietly losing over time. In 2025, this problem has only gotten worse because inflation rates remain high and the cost of living continues to outpace the returns most people earn from traditional banks. Think about it. If inflation averages 4% and your bank is giving you 0.5% interest, you are effectively losing 3.5% of your money every year without even noticing. That's the hidden danger of being too passive with your savings, and it's why so many people feel like they're running in place financially, even when they're doing the responsible thing by saving. The solution is not to stop saving. It's to put your savings to work in smarter places. Instead of letting your emergency fund or extra cash rot away in a standard account, you can shift it into high-yield savings accounts, certificates of deposit, CDs, or even short-term treasury bonds. These vehicles are designed to offer significantly better returns while still being safe and accessible. High-yield savings accounts in 2025, for example, are paying anywhere from 4% to 5% annually, depending on the bank. That means the same amount of money that would have earned you $50 in a traditional account could now earn $400 to $500 just by switching where you keep it. It's the same savings, the same effort, but a very different outcome. And the best part is that it doesn't require complex investing knowledge, risky decisions, or long-term commitments. It's simply about being intentional with where your cash sits and making sure you're not falling behind to inflation. CDs add another layer of strategy because they allow you to lock in a fixed interest rate for a specific time frame, which can be incredibly valuable in a period of uncertain interest rate changes. By laddering CDs or mixing them with high-yield accounts, you create a flexible yet rewarding safety net for your money. For example, let's say you have $10,000 sitting in a regular savings account paying you 0.3% interest. Over the course of a year, that money would make you about $30, barely enough to buy dinner. Meanwhile, if you took that same $10,000 and placed it in a high-yield savings account offering 4.5%, you would earn around $450 in the same period. That's the difference between your money shrinking versus your money quietly growing in the background. And here's where it gets even more powerful. If you combine strategies, you can structure your savings to handle emergencies while still maximizing returns. Maybe you keep $5,000 in a high-yield account for easy access, put $3,000 in a one-year CD paying 5%, and another $20,000 in a 3-month treasury bill. Not only is your money protected and liquid enough for unexpected expenses, but it's also generating hundreds of extra dollars each year without requiring any risk. This is the type of small shift that separates people who feel broke despite saving from those who steadily build wealth. It's not about how much money you have. It's about how you manage it. By moving idle cash into the right accounts, you essentially give yourself a pay raise without working extra hours, stressing over investments, or gambling in the stock market. This is the beginner's foundation for wealth building in 2025, and yet it's a step most people skip because they assume their regular bank is good enough. The truth is, good enough is costing you every single year. The discipline of putting your money in the right place creates habits that scale later when you have more money to manage, but the mindset begins now with how you treat even the smallest savings. A major problem beginners face when it comes to money is not having a proper safety net in place before they even think about investing or growing wealth. Too often, people rush into the stock market, crypto, or even real estate without first protecting themselves against life's unexpected curveballs. The result? They end up selling investments at the worst possible time just to cover an emergency expense, or they go into debt on a high-interest credit card because they didn't have cash readily available. Without a safety net, every financial move feels like walking a tightrope without a harness. You might balance for a while, but one small shake, like a car repair, medical bill, or job layoff, can send you crashing down. In 2025, with rising costs, unpredictable job markets, and global uncertainty, the risk of not having an emergency fund has never been more dangerous. What's worse is that many beginners underestimate how quickly unexpected expenses pile up, and they assume, won't happen to me, until it inevitably does. The solution is to build an emergency fund, your first line of defense against financial stress. An emergency fund is essentially cash set aside specifically to cover 3 to 6 months of essential living expenses. That means rent or mortgage, groceries, insurance, utilities, and transportation. The purpose is not to earn the highest possible return, but to give you security and breathing room when life throws you a surprise. Once this foundation is in place, you gain freedom and confidence to take bigger financial steps, like investing, without the constant fear of needing to pull your money out early. The key is to keep this fund liquid and accessible, so you don't lock it away in an investment that's hard to access. A high-yield savings account is ideal because it offers both growth and immediate availability. Some people also use short-term money market accounts or even laddered CDs for part of their emergency fund if they want slightly better returns while still keeping money fairly liquid. The important thing is not the exact product, but the habit of separating this money from your daily spending and never touching it unless it's a true emergency. For example, let's say you're just starting out and your monthly expenses come to about $2,000. To cover 3 months, you'd want at least $6,000 in your emergency fund, and ideally, you'd build toward $12,000 for 6 months of coverage. If you don't have that yet, start small. Even saving $500 can make a huge difference because it immediately shields you from falling into credit card debt the next time your car breaks down. Imagine two different people facing the same $1,000 in emergency expense. One person has no emergency fund and has to swipe a credit card with a 20% interest rate. They'll now owe thousands and $200 after a year if they can't pay it off, and the debt will snowball further if they keep only making minimum payments. The other person has been slowly building an emergency fund in a high-yield savings account. When the expense hits, they pay it from cash, and while it might sting to see the balance dip, they can rebuild it over time without stress or interest charges. That one difference determines whether they spiral into debt or stay on track toward financial independence. This is where the mindset shift becomes critical. Too many beginners think an emergency fund is boring or unnecessary because they want to skip ahead to the exciting part, investing. But the truth is, the emergency fund is what makes investing possible without fear. It protects your investments from being liquidated at the wrong time, and it protects your lifestyle from collapsing when life happens. Building it doesn't have to be overwhelming. You can automate small transfers each week, round up purchases into savings, or direct side hustle income toward it until you hit your goal. Once it's in place, you'll notice a dramatic shift in your confidence. Suddenly, job loss, car trouble, or medical bills don't feel like disasters. They're simply inconveniences you can handle. That peace of mind is worth far more than the return you might have gotten by skipping the fund and investing right away. One of the most common mistakes people make when managing their money is failing to optimize the way they save. They may have already built a small emergency fund or have some extra cash set aside, but instead of putting it somewhere it can actually work for them, they default to letting it sit in a checking account or traditional savings account that pays practically nothing. The problem is that inflation continues to erode purchasing power every single year, and if your savings aren't keeping pace, you're effectively losing money without realizing it. In 2025, this problem is even more significant because interest rates on standard savings accounts at big banks are still a fraction, while inflation and the cost of living continue to rise. So even though it feels safe to keep cash parked in a familiar account, the hidden danger is that it's quietly shrinking in value. Most people ignore this problem because they think small differences in interest rates don't matter, but over time, the gap between what your money could have earned and what it actually earns becomes massive. The solution is to strategically allocate savings into accounts and products that take advantage of higher yields while maintaining safety and accessibility. High-yield savings accounts, certificates of deposit CDs, and short-term treasury bonds are some of the best tools available in 2025. High-yield savings accounts in particular are widely accessible, insured, and offer interest rates 4 to 5 times higher than traditional banks. This means that without taking any additional risk, you can immediately start earning significantly more on the money you were already saving. CDs provide another option for those who don't need immediate access to their funds, allowing you to lock in higher fixed interest rates for a set period, which is especially valuable in a volatile interest rate environment. Meanwhile, short-term treasury bonds give you the safety of government backing with yields that often outperform traditional savings accounts. By splitting your savings across these products based on your liquidity needs, you can maximize returns without sacrificing safety. For example, imagine you've managed to save $20,000. If you leave this in a checking account paying 0.1%, you'll earn only $20 for the entire year. In contrast, if you move the same $20 into a high-yield savings account paying 4.5%, you'll earn $900 in the same period, money that compounds year after year with zero extra effort. To take it a step further, you might keep $10,000 in the high-yield savings account for easy access in case of emergencies, put $5,000 into a one-year CD paying 5% to lock in a slightly better rate, and invest the remaining $1,000 into 3-month treasury bills for both security and a modest return. Now, not only is your money working harder for you, but you also have flexibility, cash available for immediate needs and higher, yielding options building quietly in the background. Over time, the difference becomes dramatic. 10 years of leaving money in a standard account could leave you thousands of dollars poorer than if you had simply made the smarter choice of reallocating to high-yield products. This is the kind of optimization that separates people who passively drift along financially from those who actively grow their wealth, even at the beginner stage. The beauty of this strategy is that it doesn't require advanced investment knowledge or risk tolerance. It's simply about being intentional with where your money lives. Too many people fall into the trap of thinking only big investment moves matter, when in reality, even small adjustments like switching savings accounts can create a ripple effect over time. Every extra dollar earned from higher interest can be reinvested, added to your emergency fund, or used to cover life's unexpected costs without dipping into long-term investments. This approach also helps protect your mindset. When you know your cash is earning something meaningful instead of just sitting idle, you build the discipline and confidence needed to take bigger financial steps later. It's not glamorous, but it's effective. And in 2025, it's one of the smartest shifts you can make with your money. One of the biggest problems people face, once they've set aside some cash and maybe built a small emergency fund, is not knowing how to actually grow their money long term. They know leaving it in savings accounts won't make them wealthy, but the moment they think about investing, they freeze. The stock market feels intimidating, individual stocks seem risky, and the news constantly highlights volatility and crashes, which makes beginners even more hesitant. This leads many people to delay investing altogether, waiting for the perfect time, or until they learn enough. But in reality, the perfect time never comes. The real danger of this hesitation is that they miss out on years of compounding growth. Every year they sit on the sidelines, they lose opportunities that could have multiplied their wealth. By the time they feel ready, they're often playing catch up, which makes it harder to reach financial independence. In 2025, this problem is especially relevant because while markets remain volatile, they've also created some of the best long-term buying opportunities in years. Not investing at all is often riskier than starting with a simple strategy that steadily grows wealth. The solution is to focus on proven, beginner-friendly investments that balance growth and safety, index funds and ETFs. These are collections of stocks bundled together to represent either the entire market or specific sectors, making them automatically diversified. Instead of trying to pick the next big stock and risk getting it wrong, you can buy into funds that track the overall growth of the market. Historically, broad market index funds like the S&P 500 have returned an average of 8-10% annually over the long run, which is significantly higher than anything a savings account or CD can offer. ETFs, exchange-traded funds, take it a step further by allowing you to buy into different industries, bonds, or even international markets with low fees and high flexibility. For beginners, this approach simplifies investing because it removes the need for constant research and market timing. The strategy becomes less about guessing and more about consistently putting money in over time and letting compounding do the heavy lifting. For example, imagine two people each have $5,000 to invest in 2025. Person A is nervous about the market, so they leave their money in cash, earning maybe 4% in a high-yield savings account. At the end of 10 years, their $5,000 grows to about $7,400. Person B decides to invest in a broad market ETF that tracks the S&P 500, averaging 8% annually over the same time frame. At the end of 10 years, their $5,000 grows to over $10,700. That's a difference of more than $3,000 simply because one person allowed their money to compound in the market while the other played it safe. And if both continue adding just $200 a month into the ETF, after 10 years, Person A's cautious approach nets them around $34,000, while Person B's consistent investing grows to more than $37,000. The gap only widens over decades, showing how powerful compounding becomes when you start early and stay consistent. The beauty of index funds and ETFs is that they give beginners an easy, low-stress way to get into investing without having to know every detail of the market. You don't need to guess which company will succeed. You don't need to track stock charts daily, and you don't need to take on excessive risk. Instead, you're betting on the overall growth of the economy, which historically has always trended upward over the long term, despite short-term dips. This is also where dollar cost averaging comes in by investing a fixed amount regularly, whether weekly or monthly. You smooth out the volatility of the market. Some months you'll buy shares when prices are high, other months when they're low. But over time, the average price balances out, reducing the stress of timing the market. This step is critical because it marks the transition from simply protecting money to actively growing it. Too many people stop at the savings stage and never graduate to the investing stage because of fear. But the truth is that with index funds and ETFs, the risk is far lower than they think. The real risk is waiting too long and losing the years of compounding they can never get back. Investing doesn't need to be complex to be effective, and once you take that first step, you'll realize how simple and powerful this strategy really is. One of the biggest mistakes people make as they move beyond the basics of saving and investing is failing to diversify their wealth into multiple streams. Relying only on stocks or a single investment category leaves them vulnerable to downturns, and relying only on a single source of income, like a paycheck, puts them at risk if that income ever disappears. The problem with putting all your financial eggs in one basket is that life and markets are unpredictable. If the stock market dips, if your job cuts back hours, or if inflation spikes, suddenly everything you've built feels shaky. Many people ignore this risk because things seem stable in the short term, but when the unexpected happens, it exposes how fragile their financial foundation really is. In 2025, this problem is especially urgent because markets are volatile, companies are restructuring with new technologies like AI, and the cost of living continues to climb. Depending on just one asset or one income stream is like balancing on a single leg. It works until the ground shifts, and then you collapse. The solution is to think beyond just saving and stock market investing by diversifying into real estate side hustles or alternative assets. Real estate, for example, has historically been one of the most reliable ways to build long-term wealth. It offers both appreciation and passive income through rentals, and in 2025, there are opportunities in areas where housing demand is rising faster than supply. Even if you don't have enough capital for a down payment on a property, real estate investment trusts, REITs, or fractional ownership platforms make it possible to get exposure to the market with far less money. Side hustles are another powerful form of diversification because they create new income streams outside of your main job. This could be anything from freelancing to e-commerce to leveraging your skills on platforms that allow you to monetize your expertise. By having multiple income streams, you protect yourself from relying too heavily on one paycheck. Finally, alternative assets like gold, crypto, or even private lending can serve as small parts of a diversified portfolio. While these should never replace core investments, they can provide protection or growth opportunities in different economic environments. The goal is not to spread yourself too thin, but to build a balanced mix of assets and income that can weather storms from multiple directions. For example, imagine someone has $50,000 invested only in the stock market. If the market drops 20%, their portfolio suddenly falls to $40,000 and they have no other assets or income streams to balance the loss. That creates panic, which often leads to bad decisions like selling at the bottom. Now imagine the same person takes that $50,000 and splits it strategically. They keep $30,000 in index funds and ETFs, the $10,000 invested to a REIT paying steady dividends, and use $5,000 to build a small online side hustle that generates $300 a month in profit. The remaining $5,000 is placed into alternative assets like short-term crypto holdings or precious metals. In this case, even if the stock market drops 20%, they still have rental income from the REIT, cash flow from their side hustle, and some stability from their alternative assets. The impact of the downturn is softened, and instead of panicking, they can continue investing at lower prices. Over time, that diversified mix not only grows wealth, but also provides stability and confidence through different economic cycles. This approach also changes how you view money. Instead of seeing it as something that comes only from a paycheck or only from one investment, you start to understand that wealth is built by stacking multiple streams together. Real estate gives you equity and cash flow, side hustles give you immediate income, and alternative assets give you protection. Even if one area slows down, the others keep you afloat. In 2025, when uncertainty is everywhere, this kind of diversification isn't just a nice idea, it's a necessity. It ensures you're not overexposed to a single risk and that you always have options. Building wealth becomes less about hoping one thing works and more about designing a system where multiple things work together to move you forward. A common problem people face once they start building a portfolio is that they chase returns without thinking about the risks. They hear about friends making quick money in stocks, crypto, or real estate, and they jump in with the mindset of maximizing growth at all costs. Others go the opposite direction and stay so conservative that their money never grows beyond a safe savings account. Both approaches come with danger. On one side, overexposure to risky assets can lead to devastating losses when markets drop. On the other, being overly cautious means inflation slowly eats away at purchasing power, leaving you stuck behind. The real problem here is imbalance. Without a plan for managing risk, your portfolio becomes fragile. And when the economy shifts, as it inevitably does, you either lose big or fail to keep up. In 2025, this challenge is even more pronounced because global markets are volatile, new asset classes are emerging, and traditional safe havens don't always offer the same protection they once did. The lack of balance leaves many investors constantly anxious, second-guessing their moves, or paralyzed by fear of making the wrong choice. The solution is to create a portfolio that strikes a balance between growth and protection, tailored to your risk tolerance and goals. This is where asset allocation comes into play. By dividing your money across different asset classes, stocks, bonds, real estate, cash, and alternatives, you reduce the impact of any one category performing poorly. If stocks are down, bonds or cash reserves can offset losses. If inflation rises, real estate or commodities might protect your purchasing power. The idea isn't to eliminate risk completely, because growth always requires some level of risk, but to make sure you're never overexposed in a way that could derail your financial progress. For beginners, a simple 60-40 portfolio, 60% stocks and 40% bonds, has historically been a reliable balance. For those with higher risk tolerance, maybe it's 70-20-10 across stocks, bonds, and alternatives. In 2025, You also have access to target date funds and robo-advisors that automatically adjust your allocation based on your timeline and comfort level. The key is consistency, not chasing trends. A balanced portfolio allows you to stay invested through the ups and downs without panic, which is what ultimately builds long-term wealth. For example, let's take two investors with 100,000 each. Investor A puts everything into tech stocks because they've seen big returns over the last few years. If the market takes a 30% hit, their portfolio drops to 70,000, and fear might cause them to sell, locking in massive losses. Investor B splits their 100,000 into 50% index funds, 30% bonds, percent real estate via rights, and 10% cash or alternatives. In the same downturn, their stocks drop, but the bonds hold steady, the rights continue to pay dividends, and the cash gives them flexibility to buy more at lower prices. Instead of falling to 70,000, their portfolio might only dip to 85,000. That difference is huge, not just in numbers but in psychology. Investor A feels crushed and may give up investing, while Investor B sees the downturn as a manageable setback and even an opportunity. Over decades, the second investor consistently comes out ahead, not because they always had the highest returns in good times, because they avoided catastrophic losses in bad times. This balance also gives peace of mind. When your portfolio is designed with risk management in mind, you're no longer checking prices every day in a panic. You know that no matter what happens in the short term, your mix of assets is designed to protect you. That confidence makes it easier to stay the course, continue investing regularly, and take advantage of compounding. It also helps you adapt to different stages of life. When you're younger, you might lean heavier toward growth, knowing you have time to recover from downturns. As you get closer to retirement, you naturally shift more toward protection. The principle stays the same: balance creates stability, and stability allows consistent progress. In 2025, with so much uncertainty in the economy and markets, this approach is not just smart, it's essential. It ensures you don't gamble away your future by being too aggressive, and you don't let fear quietly erode your wealth by being too conservative. Instead, you build a resilient portfolio that keeps moving forward regardless of what the headlines say. So quick recap: stop letting money sit idle in low-interest accounts, build that emergency fund as your first line of defense, take advantage of high-yield savings and CDs for smarter cash allocation, invest consistently in index funds and ETFs for long-term growth, diversify into real estate, side hustles, and alternative assets to create multiple income streams, and finally, balance your portfolio so you're protected against market swings while still building wealth. If this breakdown helped you figure out where to put your money in 2025, make sure to hit that like button. Subscribe if you haven't already, and drop a comment with what strategy you're starting this year. I read them all. And don't miss the next video, where I'll reveal the exact mistakes keeping most people broke in 2025 and how you can avoid them. It's going to change the way you think about money forever.